Awesome. Hello, everyone. Thank you all for being here today. Today, I'm here to talk about the economics of wash trading. My name is Leo, and so essentially, like, who am I first? I'm Leo. My real name is Advait. And essentially, I'm the founder of Supersite. And what we're doing is we're building like crypto-specific large language models. And essentially, what we try to do is like we try to make sense of the information in the sea of noise. So we're trying to build large language models that are specialized to both on-chain and off-chain information. And additionally, like what I do is I'm a PhD candidate at London Business School, and my research specialization is in crypto wash trading. And previously, I was the head of research at Fabric Ventures, lecturer of portfolio management at UCL, and I was also a lecturer of machine learning at O'Reilly. And let me tell you a bit more about the meat of the presentation today. So we're going to be talking about wash trading. And I'm going to start out by explaining the concept of wash trading for those who are not familiar in the room, despite it already actually being a very popular concept. But essentially, like what wash trading fundamentally is when like two parties actually exchange assets in between them without the risk actually ever like being transmitted to either party. Like that is the like proper financial definition of wash trading, and how we observe it on chain is that essentially like if you look at this loot, like this loot was actually wash traded between two parties, let's say John and Lisa. So this loot was sold for 472 Ethereum from John to Lisa and then back to John. So essentially, we can see that like there was a lot of volume in these trades, but like there was actually no exchange of firstly like money and assets. So like this is a concept that I found very interesting that is prevalent in the NFT markets. And so essentially like I was really intrigued by this problem, and I wanted to see how big of a problem is it. So essentially, like I looked at like the NFT transactions that for collections that have greater than 100 Ethereum in volume, and what I find is that 73% of my sample is actually wash traded, and which is like super surprising. And then if we like dig into it deeper, then essentially what I found was that before 2022, like the amount of wash trading that was happening in the NFT markets was more or less very healthy. But then like from 2022 onwards, like it just exponentially grew. Like we can actually see that the amount of wash trading in the NFT markets was more than like the amount of real trading in the NFT markets for most of 2022. And so like, how do I actually detect wash trades? So in order to actually detect wash trades, what I do is I employ a graph-based cycle detection methodology. So we know that like wash trading can happen between like two wallets, but like it can also be happening all the way up to like 50, 100 wallets. It doesn't matter what that N is. And so like I basically try to look for whenever like a cycle is completed in a transaction graph. And what I flag is that each of the wallets in those transactions is actually a wash trader. And I was really curious about why does it actually happen? Like, why do people wash trade so much in the NFT markets? Why did it actually start in 2022? And so firstly, like, let me tell you a bit more about wash trading in the financial markets. So in the financial markets, it's actually illegal to be wash trading. So essentially, like, what happens is a lot of people will like used to try to sell their stocks in December and then buy the same stocks back in January. And essentially what they were doing was like writing like the tax, writing the stock as a tax write-off. And what they were doing was tax loss harvesting. And then I tried to find instances of this in the NFT markets, and I found some. So if you actually like pay attention to what happens in December and January, you'll find that like in December, like the price of NFTs slumps a little because there are, if you look at the average prices, and then in January, like it starts picking up like for no reason in the first few weeks. And what's happening is that like a lot of people are buying the same asset that they sold. So it looks like there's a lot of things happening. And so this was my first hypothesis, but then like I realized that this cannot explain the entire phenomena. Then I thought that maybe it's that like, wash sellers probably want to pump up the volumes of their collection to make it look more attractive to investors. Like, do they actually just want to make sure that their assets get sold at a higher value? And this was motivated by the fact that when I looked at like what was happening to the average prices of NFT sales, so essentially like in January, we can see like the average prices of wash sales touched $500,000 in a week. And I thought maybe this is what's happening. But then I dug deeper into where is it happening. And then I realized that like before 2022, like the amount of wash trading that was happening was all on OpenSea, which was a small amount as we saw. And then from 2022 January, like it was on LuxRare. From like May, it was on X2Y2, and like October onwards, it was on Blur. And essentially what all three did was like they launched token rewards programs. So you were actually motivated by a financial incentive by marketplaces to wash trade. And I looked deeper into like what is happening at the collection level. So like these two plots actually showcase like what's happening in two popular collections. The first on the left is Bored Ape Yacht Club. The second on the right is Terraforms. Terraforms is mostly wash traded. Like I was completely shocked by the amount of wash trading that I found in Terraforms. According to my analysis, it was $12.2 billion of wash trading. And then, essentially, I looked at like Bored Ape Yacht Club, and what I found was that like the my index for wash trading actually grows like around the rewards programs launches for LuxRare and X2Y2. And if we actually dig deeper, then there was a very clear incentive for traders to actually be wash trading. So essentially, like you can see, like the green like area that is marked between these two lines. So that is the difference between the token price and the break-even price. And so essentially, like this was the incentive that like the wash traders had for wash trading. And essentially, like in my research, what I did was like I did like over 100 regressions to actually figure out the relationships between like all of these metrics, like what is happening on the volume level, what is happening on the price level, what is happening to the number of transactions, what is happening to the market. And essentially, what I find is that like in the overall market, like wash trading is actually like essentially it drowns out, and there is no significant relationship between volumes or prices of like wash volumes with real volumes in the following days. But like if we go deeper into like what is happening like on an exchange level, what I found was that wash volumes today actually positively impact real volumes tomorrow, but they negatively impact real volumes all the way forward. So essentially, like what I found was that like my indices showed the same results, my prices show the same results. So essentially, what I found is that wash trading in the short term is good for the market, but in the long term is actually negative for the market because it discourages people from buying the like assets that are heavily wash traded. And then I was really curious about like, are people actually making money from wash trading? And so like on the right, like I know it's a bit small, but essentially what I found was the PNL for all of these wallets that do wash trading was more or less negative. So I wasn't very sure like whether they're actually making money or not. And Machi is very popular in the community for this. I don't know if he's going to get the rewards in proportion to his efforts. But I did not really find much evidence that it's a very profitable activity. But it may be because like wash traders have multiple wallets. So essentially, like these wallets might be in loss while others are in profit. But yeah, I mean, like, if you actually want to find the same insights that I found, like, after digging in, like, for hours on end through, like, different analytics platforms, then essentially you can use Supersite. And what we're building is like, a system for you to be able to, like, ask these questions in natural language so that, you don't have to write any lines of code. But so that was me. That's Supersite, and that's wash trading in the NFT markets.
We have 5 minutes left for question.
Hi, Leo. Thank you for this talk. Really interesting and great data. I had a question about whether or not you looked at different communities. So if you found, so you compared a Bored Ape Yacht Club with Terraforms, and if you found any other types of patterns in the types of trading activities. So, for example, risk taking or maybe holding activity or other types of patterns.
That's a great question. So I did do a bit of a deeper dive into like each of the top NFT collections to find like, firstly, like how loyal are their communities? So like what is the retention statistics like for each of these communities? And then, so I found out that I mean, before all of this happened, like Azuki was one of the most loyal communities. I haven't checked since like the events took place, but yeah, you're right. There's actually a lot that we can get from looking at blockchain data. And if you want to ask any of these kinds of questions, then you're welcome to use Supersite, because you can directly ask questions like retention statistics for Azuki, or if you want to compare it to other NFT collections, so you can do that.
Well, I'm not too far away from you. I'm at Cass Business School, so I'll definitely follow up.
Deal.
Looking outside the context of NFTs, have you analyzed platforms like DYDX in the context of wash trading, specifically when you're looking at long-term liquidity? And because I would argue that maybe their incentives have kept long-term liquidity on the platform over the past few years.
That's a great question. I haven't actually looked at the fungible token markets yet, but I see where you're coming from. Like essentially, like traders do have an incentive to like wash trade on spot so that they can manipulate the price of perpetuals as well. I think that there are actually a lot of incentives for wash trading, like as you mentioned, plus like just like being able to exploit these instruments. But yeah, I think that would make for interesting research that I've not done yet, but hopefully I can look into it soon.
Thanks.
Hey, thanks a lot for your presentation. Super insightful. Maybe just one question back on the, I think, very first chart that you showed, which was like the proportion of wash trading across platforms over time. I think that was the one with the red and green. I was the one before actually, showing non-wash versus wash. And I was surprised to see there was like basically zero or almost zero wash before January 2022, and then it just spiked like crazy, which is like seems odd. So I don't know if you had some insights or potential explanations for this like sudden move from January.
That's a great question. Like, to be honest, like before the launch of LuxRare, which happened in January 2022, like all of the wash trading was happening in OpenSea, and like there is a small amount there, which is actually less than 2%. I mean, what I found was like essentially a lot of that was happening in like the CryptoPunks collection and a few like other collections, like 3 or 4. But it was not that prevalent of an activity because it was just not as incentivized. And then like in January, LuxRare launches with its rewards program, and then like the proportion just goes out of control. Awesome. Okay, thank you everyone.